Have you ever wondered how to become a millionaire via property investment? It's not a game only for rich people. Everyone can do it. In today's video, I'm going to explain to you how to earn $1 million in real estate in just 10 years. I have done it, my company staff and our VIP members are doing it, and yes, you can do it too. It's a proven strategy that can help everyone to achieve financial freedom. This episode is for beginners, and I will explain everything as simple as possible. Hey there, my name is Alex. Welcome to my channel, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. A lot of people have no idea how to make money from buying properties in Australia. My last video explained it in detail. If you missed it, you may want to check it out. In short, there are 4 ways to profit from buying properties in Australia. Capital appreciation. Over time, your property's price will increase. Capital appreciation could be the difference between the buying and selling price or the increase in value from holding onto the property over the long term. And then there's the cash flow. It's the rent generated from the investment property minus expenses and tax. And then tax benefits. Taxes aren't just what you owe to the government, but include tax savings obtained through tax deductions. And finally, the inflation. Some may think once a mortgage is drawn, its amount is set, and repayment is the only way to decrease it. Well, not really. There's also inflation. The value of a $500,000 mortgage today will be very different 20 years from now due to inflation. The value of the mortgage is actually decreasing over time, making repayment easier. Now that I have explained 4 ways of wealth growth through property investment, let me show you a simple example of how to quickly become a millionaire by using these 4 methods together. Let's start with something simple. Suppose you invested in the property with $1 million, made a cash down payment of $200,000, and took out a loan of $800,000. With an interest rate of 6% based on the current market and a mortgage term of 25 years, the mortgage will be paid off in 25 years and you own 100% of the property. Firstly, the property itself will appreciate. As Australian property prices rise, the equity in your property, which is the portion of the property that you own, will also increase. In the long term, property prices generally increases by 7% per year. So your $1 million property bought this year will be worth nearly $1.96 million in 10 years. In the same time, your monthly mortgage payments will gradually pay down the principal, and $800,000 mortgage when you bought the property will reduce to just under $610,000 after 10 years. And the equity in your house, which started at $200,000 when you bought the house, will increase to almost $1.36 million. This is the property's value in the 10th year minus the remaining loan balance. At this point, your equity has risen by $1.16 million, and congratulations, you've earned your first $1 million within 10 years. The equity in this house will continue to increase over time. Even if you only repay the interest without reducing the principal, the value of your property after 25 years will far exceed the initial loan amount of $800,000, and your equity will significantly increase. I know you might have a lot of questions at this point, but don't worry, we'll address them one by one. The Australian property market increases by 7% annually. At this point, the real estate market has cycles. Each state or territory has its property market cycle. At the same time, house prices in Sydney might be rising while those in Perth are falling. Different types of properties in the same city may also have different cycles. For instance, detached houses might be rising in value, apartments might be falling. The luxury properties market might be booming, and the low-end properties might be flat. So this annualized increase of 7% is just an average. The annualized growth for certain properties in certain areas might be 10%, while only 4% in another nearby area. Some suburbs even see no increase in property prices over 10 years. Given the compounding effect of wealth, this could be a huge difference, which is where our investment platform comes in. Thanks to our deep understanding of the market and our dedicated research team, our Vision members typically purchase high-appreciating properties with our support. Detached houses are generally more likely to reach this average increase than semi-detached houses or apartments. Longer holding periods, such as 15 to 20 years, are more likely to achieve this average than short ones, such as 1 to 5 years, because averaging out the price fluctuations reduces the volatility. The example above was simplified to make it clear and easy to understand. However, during the repayment process, you will need to make payments to pay back the loan. Of course, you can choose only to pay the interest or pay the principal and interest, but you always have to pay back some money. And there are various costs such as property taxes, land taxes, council rates, and property management fees. So where does this money come from? Simply put, part of it comes from the rental income of the property, and another part comes from tax deductions. If the property has a good rental income and is relatively new, the income from rent and tax deductions should roughly equal to the cost of holding the property. This means the property is cash flow neutral, and you won't need to pay out-of-pocket money to hold the property. However, with the current high interest rates, even considering tax deductions, a property's cash flow might still be negative, meaning it is losing money. We've done some calculations for you, and for someone earning $100,000 a year, the net loss of holding a property worth $800,000, factoring in depreciation, is only about $70 a week, the cost of 2 cups of coffee a day. Well, if you think about it, the daily cost of 2 coffees in return for an average 7% annual increase in the value of the entire property is absolutely a great deal. I know many of you might be thinking, oh, I can't afford to buy a property worth $1 million. Or I have to wait for 10 years to earn $1 million. That's too slow. Well, this is what we're going to discuss next. I will break it down and explain the power of compounding in real estate investment. Let's say you did not buy a $1 million property, but $500,000 instead. The down payment is 20%, which is $100,000. And you take a loan of 80%, which is $400,000. Well, after 2 years, the same property appreciates and is worth $572,000. Then you decide to refinance your loan based on the new property's value. And with 80% loan, you get a brand new $458,000 mortgage. After paying off the initial loan of $400,000, you still have $58,000 left in cash. It can be used as part of a down payment for your next property. Then you purchase the second property worth $572,000 within the same year, requiring a 20% down payment of $114,490. However, since we have $58,000 from the refinancing of the first property, we only need an extra $56,000 in cash to buy the second property. Simple like that, we've bought the second property. You will realize that by the 5th year, when you buy your third property, you won't need to pay out-of-pocket cash. The money from refinancing is more than enough for a down payment, and the third property is easily added to your portfolio. At this point, the equity from all properties has reached $394,000, and the total cash you've put in is only about $155,000. From now on, buying more properties will only require refinancing. No more cash is needed from your pocket. Your equity also reaches $1 million by the 10th year. Congratulations, you're now a millionaire. If you want to make $1 million faster, you'd need to buy more properties, buy earlier. Yes, I know you have questions. The first question would be, how can I get loans for all these properties? This is a good one. Under the current market condition, an annual salary of $100,000 can only get you a $500,000 mortgage, at most. However, there are many strategies to solve this problem. Joint loans with a spouse, guarantee from your parents, business revenue, overseas income, rental income from investment properties, self-managed super fund, etc. All this can boost your borrowing capacity. We have a dedicated team of mortgage strategists to help our VIP members to manage their loans. Secondly, the market does fluctuate. It doesn't always appreciate at a fixed 7% annual return. That's where I come in. I've helped hundreds of people to invest in different cities just to put properties in different cycles and use the local tax law for more deductions and boost the cash flow. Thirdly, with all these loans, how do I repay them? This is a great question. I bet a lot of people have the same question. A larger loan can be challenging to repay, but why would you pay off the loan at all? Loans simply provide a finance leverage. They allow investors to control a larger asset base with less capital, leading to faster wealth accumulation. As long as we can manage the cash flow during the holding period, we can keep the property for longer and get more stable long-term appreciation. Our ultimate goal is not about the amount of loan or the number of properties, but the equity in the property that belongs to you, also known as net asset. If you want to be debt-free, you can choose to sell a few properties and repay the remaining loans. This is a strategy our Vision members have been using since day one. Property investment is just a game of financial leverage and time, with properties as the vehicle. If you've made it this far, please give a like, subscribe, and share this video with your friends. Turn on the notification bell to watch new weekly videos, and follow me on social media at Real Coach Alex. Hope to see you soon. Have a good one. Bye bye.